So this is where we go and we talk about business and getting funding and how you can get your business funded or your future business, or if you're thinking about opening up a shop, this is the place to be, because what we're going to do is we're going to show you how to do it and how to do it the right way and not have as many bumps along the road along the way. So what we're going to be doing is we're going to talk today about the five crucial or critical factors that determine your business credit worthiness. So last week, what I did was I talked about a fundability. So we're going to be doing that a little bit, and also getting into more details of what's at. The question that is scrolling across the bottom is, where are you watching from? So I wanted to find out. I do have people in the group that are all the way around the world, and so I want to find out where you're calling from, where you're tuning in from, and let's see if I can get you some help. But first, my name is Brian Whedon. I'm the CEO of Zen Lending and Consulting. There's my contact information. I'm located in El Paso, Texas, and I can do funding nationwide. I am currently on my wish list, I guess, is to go worldwide, at least to Mexico and the Philippines. But right now it's just the United States. So my phone number, 915-229-4891. If you have any questions or anything like that, you want to get in contact with me, info@yourzenlender.com is a great place to do that. We'll be able to get contact with you. But last week, what I ended up talking about was a fundability wheel. So I wanted to bring this up. This right here is the fundability wheel. So all businesses need funding. And what does it take to get business funding in the business name and not on your personal credit? There's 125 different factors that go into it. I did not make this fundability wheel. A friend of mine, Megan Christensen, did so, and phenomenal. So why try and reinvent the wheel? This is what it is. So every week we'll be talking a little bit more about how to get that, and also how to let me see if I can get a little bit closer or a little bit easier for you to read. Now, not sure if that'll work or not, but let me see here. Trying to figure this out here. All right, let me see if I can get this a little bit bigger. It is a lot of information to deal with. So maybe it's a little bit easier here. All right. So one more time. There we go. All right, so this is the fundability wheel, and if you can see it, there's 5 different major parts to it: the foundation, business credit report, your personal credit, the application process, and the financials. Subsections and then subsections to that, and so there's a lot to go with it. And what I find when people want to get information on getting funding for their business, what they end up doing is they just want to get personal. They'll be willing to personally guarantee it. I don't recommend it, because that means that you're on the hook, and now it's very detrimental if your business doesn't become successful or is having a rough time to get off the ground. So what we want to do is we want to bring the business credit into it to where it covers its own bills and grows and that such like that. So, all right. So business credit is credit under the business name, and it is reflected as how well the business can pay its debts, not the owner. Now, this can widely differentiate, be different in all sorts of different things, but that's basically the main object of the game, is to get your business to become more fundable and to get it in their name and not in your personal name, so that you can have the separation that you need for both you and the business. So a couple of interesting things. Now, everybody, most people know about the Fair Credit Reporting Act. Business credit does not follow that, does not have to. There's no federal law or state law as of this recording. There's nothing that that helps protect your business credit. Anybody can pull it. That means your business partners or future business partners, your competitors, your suppliers, anybody. If you had $49 and a business name, you can pull anybody's business credit you wish. So it just really matters as to what does your business credit report show, and how does it present your business to the world, or location, the world, or anything else. So we'll get into a little bit more into that, but that's pretty much it. It's not subject to the Fair Credit Reporting Act, and they don't even have to let you know that they're going to pull your credit. So creditworthiness is the lender's calculation. It determines the probability, the possibility of you becoming a client of theirs, or the chances of you defaulting on your debt obligations. So this is where a lot of the business credit is going to be more important to you, because if for some reason something happens, you don't want to be personally liable and jeopardize all of your assets, your personal assets, for your business, and that definitely can happen. All right, so Investopedia did pretty well at this definition. So I again wanted to just move this real quick here. I just wanted to put it in there because it's fairly accurate. Evaluation performed by lenders that determines the possibility a borrower may default on his or her debt obligations. It considers factors such as repayment history and credit score, lending institutions, and also considers the amount of available assets to the amount of liabilities to determine the probability. All it is just the probability of a customer's default. That is the credit worthiness for the business, and it gives a good explanation as to what it means. Quite simply, the more credit worthy your business is, the more likely you will get favorable credit terms, and it can mean that the difference is between getting a loan or credit at all. There's a lot that goes into it. The more credit worthiness your business is, the more that you could save on your interest and the terms of the loan. So everybody, at the end of the day, all we're trying to do is get the funding that we need at the most favorable terms that we possibly can. And your credit worthiness is going to be a big deal about getting it to that level. So 1, business credit score. This is your overall measurement of whether your business should even get credit. The business credit score from Duns & Bradstreet, Equifax, and Experian are the ones that are most commonly reviewed by lenders and vendors. And so those are the 3 you want to worry about. There are a couple of them. Credit Safe is one that's kind of coming into this arena. It's not as big as the 3 I've mentioned, but that one is coming into the arena with some vengeance. So here in a little bit, it might be a contender. So the scores can vary, and these credit reporting agencies calculations can also vary. It's very similar to your personal credit score. If you go check the TransUnion Experian, you can get a huge difference in credit scores depending on a lot of different factors, but they should roughly be the same and have the same consistent items for on that report. So for new businesses, sole proprietorships, lenders and vendors will look at your personal credit score. Now, we do have programs that are a lot more friendlier to startups than others, and so at the end of the day, when you first start, you are going to have some sort of personal credit score, personal dollar amount into your business. If you don't, then it's just not, they're not going to be able to look at it seriously. Because if you don't want to put any skin in the game from your end, why would they, as lenders, as vendors and everything else, why would they put it on their end? So that's something that you wanted to look at. Because you're just starting out, because you just have, you really don't have any vendors or anything like that, business credit will definitely be able to help you. And this is because your business credit score is so understandably low or non-existent at all. So they're going to be pulling more towards your personal credit and a lot less of the business credit. If a lender or your vendor asks for a social security number, it means that they are going to be taking your consumer credit into consideration. And also, depending on how that looks, it will reflect on how well the business will be able to get funding. Now, it also could mean that the creditors want personal guarantees from you. Again, you have to have some sort of skin in the game to get started. And at the end of the day, the sooner you can do it and get out of that rat race of personally guaranteeing things, the better. And also, the less that you have to put into your business to start building your business credit, the better off you are. So that's something that you want to really consider when you deal with business credit. Now, Duns & Bradstreet, it uses a predictive modeling to calculate your score. They consider the likelihood of a business failure and also the financial stress. So these factors are checked against similar companies within the same industry, and then they come up with a score that represents that. Now, Duns & Bradstreet does provide a rating based on information, your company's interim and fiscal balance sheets, and overall evaluation of your firm's credit worthiness. By the way, those two things you can help by reporting it to Duns & Bradstreet yourself. But again, if you're brand new, you're probably not going to have too much as far as evidence of a fiscal balance sheet or even your firm's credit worthiness, because a lot of it is based off of your personal credit. So it becomes a very big challenge to bring it from your personal credit to your actual business from your personal credit to your business credit in such a way that it's a lot faster and it's a lot less troublesome for you as an individual or the business owner. The scales go from 5 alpha to double H, and the classifications they vary. There are all sorts of. It does deal with the company size, its worth, and the equity that it does have. And again, like I said, they're all assigned a rating, and then you go from there. So let me see here. All right. The delinquency predictor is likelihood that your company will be late in any paying of your debts. So this takes a historical information, and Duns and Bradstreet's been around for 100+ years, almost 200 years. I believe it was in the early 1800s, 1820s, I believe. So they've been around for a very long time. They're huge, and so they have all of this data that they collect, and so they use all this historical information to try and predict the future outcomes of your business, of your industry, in your state, compared to any other areas in the United States or in the world, because they do have more than just the United States within their database. So now, that being said, it's more subjective and an intuitive judgment than anything else. They use the scoring system to rank and order accounts based on the probability of you being late. Now, this is a predictive scoring and only represents statistical probability and not a guarantee, which could be good in your favor or not good in your favor. And at the end of the day, it's still just statistical probability. And that's kind of how they do it. So how does this all work for you as a startup, or you as a medium company trying to get to that next level? There's a lot that goes into it. So any questions, just remember info at yoursendlender.com. I'll be able to get back with you and then help you kind of figure out what's the best way for you. Now, Duns & Bradstreet does create something called a Paydex score, and it's almost like the personal FICO score. It scores between a 300 and an 800, or a 350 and an 800 for your FICO score. With your Duns & Bradstreet, it's 0 to 100. So it's a little bit different, but it's the same concept, depending on all the how you pay your bills and how many credit lines you have and how they report back to them and everything else. The higher the score means the better your payment performance is. So each one has its own. And if you're brand new and think that you don't have a business credit score, you may or may not. And here's the thing about those: if you don't know you have it and there's something derogatory on your credit report, then it's like dinging yourself every single time that you try and go get credit or business line of credit or anything like that. But at the same time, if you are trying to get business credit and you don't have anything to report, then they have nothing to base it off of. And so it just becomes a really big trying to figure all this out and how to make it work for you and the best of your abilities. Now, Experian does a lot of things. Among other factors, your history of trade payments, your trends, and your inquiries from your creditors also go into it. Experian is not as big as Duns & Bradstreet. They are the largest in the world, but they're still a contender in this space. Equifax also uses it, but it takes into consideration credit usage, median open balances, current credit limits, and also your 24-month history of your company. So a little bit more, and some people might want to ask, what about TransUnion? TransUnion just decided not to get into the business credit arena, and they just wanted to stick with the consumer side of things. So those are the three that you have. Now, your payment history. Now, how well does your business pay its bills? Are you late? Are you early? Are you on time? If you're late, how late are you? The way that the Paydex score is configured or does its thing is, if you tell us your credit score, we can tell you how many days late you've been in the past to get you that Paydex score. So do you pay it in part or do you pay in full? And how does your business perform over the length of time? Really big deal. Try and pay your bills on time. your repayment history. Now, because the Fair Credit Act, the Fair Credit Reporting Act, does not apply to a business credit. Now, there are some businesses who say that they do report to business credit, but the interesting part is they don't have to. It's not required by law, and it also costs them money to report. So that being said, you want to make sure you get the right vendors. B, make sure that you pay them on time, and C, you want to make sure that you have your repayment history locked down as best you can. The credit reporting agencies generally look at the previous 12 months. They do consider your payment trends, and they do show And are you showing continuing payment failures, or is it just simply, just turning it around and just doing it when it was that a one-off? They will consider that, but everything counts. Everything counts. The length of credit history. Is your business a startup or new to credit? Now, I do know a lot of people, a lot of plumbers and electricians and such, that have been doing the trade for 20 plus years, but they're new to credit. They're new to that business credit. So this also is a very big thing that'll bring you credibility, or will make it a little bit more of a challenge to get that credit. And so at the end of the day, you're just going to want to figure out the fastest way to get to that next level, and the fastest and the most ethical way to get to that next level, so that you can get that next business credit report and get that more favorable terms for that loan or that credit. So then, is your business a startup or new to business credit? Then by definition, your credit will be poor or incomplete. And as you might expect, the main cure for this is just to be patient. Now, building business credit does not take long. You still just have to have that time. You could start building credit today, but it won't be mature to do anything for about 6 to 9, maybe even 12 months, depending on the process that you choose to take, and also the fundability factors and everything else, how often you pay your bills and how you pay them and all that. That all is to put into consideration. But it does not take as long as personal credit does. Now, also, a short business credit report or credit history will often be why a creditor wants to look at your consumer credit, or might want that personal guarantee. So they'll more likely ask you to submit your social security number to look at your consumer credit. Now, don't take this as a bad thing or a good thing. It's just part of the process. And so what my company likes to do is we like to look at your whole picture and try and find you the best option available, whether that is a loan, whether that is other means, whether that's going through one credit company or going through a bank or something of that sort. There's tons of different ways to get you the funding. We just want to make sure that we have the right option available. It makes it easier for us. Derogatory entries. Now, creditors will look at the number of negatives on your report. As you might expect, these are negatives. They do matter to the creditor, but unlike the consumer credit, there's no time limit as to how long they can stay on your business credit report. Again, there are some bills in Congress that are trying to help small businesses, but at the end of the day, we're not there yet, and so this is just what we have. So when you do have derogatory entries on your credit report, Zen Lending Consulting can help you get those off, and we'll show you how to do that. And it's it's just a process. It's the process you have to go through. So, and typically there some of these derogatories include tax liens, judgments, bankruptcies, UCC filings, which is something that we don't have to worry about in the consumer side. And have any of your accounts or any of your creditors sent it to collections? All that matters, and all that will again dictate your credit worthiness, and it also makes it a little bit more challenging, but nothing can be everything can be fixed. I'm a firm believer of that. It's just the proper way of doing it, and also the timeline to do it. So, like I said, Duns & Bradstreet currently retains up to 24 months of payment experiences. So payment experiences are the trade lines. So if you have one credit card, for example, that reports to all three of the bureaus, the business bureaus, then you have three individual. So that's something you also want to take into consideration. Now, Duns & Bradstreet will use up to 174 payment experiences worthiness in your paydex score and all that. So that seems like it's a lot. So after 24 months of payment information, then it won't affect your credit score. So your paydex score won't be as affected after the 24 months. But you could still, I mean, if you don't, again, the more you know about how Duns & Bradstreet work, the easier it is for you to put a plan together and make it the best plan that you possibly can for your current situation. In addition, the Duns & Bradstreet states on an annual basis, Duns & Bradstreet cleanses its database to remove the following filings: suit and judgments that have been inactive for 10 or more years, liens that have been inactive for 11 or more years. Hence, certain types of information, such as lawsuits, judgments, and liens, may be reported for a very long time, even longer than 24 months. On its website, Experian says dating data ensures that the information presented in the reports is current enough to create an accurate picture of financial health. So, trade data, 36 months. Bankruptcies, 9 years and 9 months. Judgment, 6 years and 9 months. Tax liens, 6 years and 9 months. UCC filings, or Uniform Commercial Code filings, 5 years. Collections is 6 years and 9 months. Bank, government, and leasing data is 36 months. So again, once you understand how these these business reporting agencies work, it's a little bit easier to make a plan, or to create a plan that's best for you and the business that you're in. Equifax, per Equifax, the commercial credit report information about trade lines that will be reported for 24 months, whether negative or not. Equifax says it does not report collections data from a third party. However, an account could list that it is in collection status. In addition, Equifax states that information can impact a business credit score up to 5 years. Now, here's some interesting ideas that you could use to get funding for your business. So for a lot of businesses, lending collateral is a must. So for businesses, lending purposes, having collateral is a must. So does your business have collateral? consider the lender's perspective. They need to know that you can pay back on time. And if you can't, then they want something so that they're not in the dark and they're not having to wait around. Now, this is any property owned by the borrower which can be pledged for security. If the property has been previously pledged against another loan, then the lenders would probably not consider it as available to be pledged again until the previous loan has been paid off. Also, collateral can take several forms. Equipment owned by a business, we can do lending up to as low as $10,000 as part of a one piece of collateral. So you have one piece of equipment that's worth $10,000 or more. We normally can get you some funding off of that. And accounts receivable, not a problem. Real estate and inventory are all considered really good collateral that we can use to get you some funding. Collateral can also be stocks and bonds owned by the borrower, a 401k account, or an IRA. Book of business if the business is an insurance company, although not State Farm's, as they do not own their own book of business. So we can use those as collateral, and it really does a very good job for independent insurance agencies to try and go and pick up more books of business. And there's a company out there that does very well. This is all they do is book of businesses lending. So that's something that you're interested in. We can definitely take a look and just info@yoursandlender.com, and we'll take a look at it. Cash flow. Now, because of COVID and everything else, this has been a challenge, but it's still not completely out of the option that we can take. So how much is coming into your business and how much is going out? Can you show that you have a new business coming in, that you have new business coming in? With COVID and everything getting shut down, that was a really big problem for us. But now that everything is starting to open back up, this might be another option for you, at least being able to take a look and figuring out what's available and how we're able to help you. So creditors do look what they look for on a balance sheet, the current ratio by comparing the ratio between the current assets and current liabilities. You determine the liquidity of the business or its ability to meet the short-term obligations. We do have the ability to look at all of that and actually give you a business valuation. It gives you some sort of a good idea as to what a third party would be looking at for your business and getting you the funding that you need. So your current assets will usually be converted into cash within 1 year and include cash and securities as well as inventory and receivables. Current liabilities are obligations payable within 1 year. And banks generally want at least 2 to 1 quick ratio, or twice as many current assets as current liabilities, but accessible ratios can vary. Now, one little thing about getting it from a bank, bank is very highly regulated, and also, depending on the bank that you use, they might have a ceiling of how much they can actually lend out. That's kind of how it works. And so if you, for example, when I started my first business, I thought I had a degree in finance and accounting. I know how business works. It should be very simple for me. I went to Wells Fargo and I said, hey, my company needs $100,000. This is what I want to do with it. They're like, no. And I didn't understand that at that point in time, that you just like if I was 18 years old trying to go and get $100,000 loan, I could do it. It's not a problem. It's just, does all of your paperwork add up? Do you have everything that you need to prove A, the need for it, and B, the ability to pay it back. That is the huge process of it, getting it, because the bank needs to make sure that they can get it paid back. So the quick ratios, our inventory is part of the value of the current asset for the business, but it can be more difficult to turn quickly. The quick ratio is similar to a current ratio, but it removes inventory from its asset the equation, and just considers cash, marketable securities, and accounts receivable into that ratio. Now, debt to equity ratio, this compares liabilities with the owner's total equity in the business. It shows how much the company is financed by debt versus the amount financed by equity. Trends over time are valuable for analysis. And if the ratio is increasing, then the business could be at risk from taking too much debt. And that's what a lot of companies did between up to 2020. They had everything was good to go, and then 2020 happened, and the world changed. And when the world changed, that means that their situation changed. And were they able to sustain themselves in a way that they would be profitable and stay in business? If not, as we saw in a lot of companies, they went and claimed bankruptcy. So this is a good indicator of the business and how it's able to continue to operate in long term. And again, 2020 showed us a whole lot. Small businesses up to even Fortune 500 companies, it just taught us all a lesson. So receivables turnover. And this is a total amount of receivables divided by the total amount of collections for a specific amount of time. If a business collects, for example, $1,000 in a week and has a total receivables of $10,000, then this business has a 10-week turnover of receivables. If the receivable turnover is increasing, then the business may have problems collecting on its accounts. So again, this will tell them this is not make it or break it in any type of way, but this is just a lot of indicators. Interest coverage ratio. This shows how well the business may cover its future loan payments. Divide the total operating cash flow, the earnings before taxes and interest, by the total amount of interest paid on the business loans. A ratio of 3-to-1 indicates that the company should be able to make their future payments. If the ratio drops under this level, then the business could have too much debt in relation to how much income they're being able to bring in. So a couple of things to improve your credit worthiness. The most effective way to raise business credit score is to pay on time, pay in full every time. And this matters more than anything else that we've talked about. This is the number one thing that will adjust your paydex score, is how you pay your bills, early, on time, or late. And if they're late, how late? Every day that you're late matters, because they do take that into consideration, and it changes your score. So developing a good repayment history is crucial and critical. Start with a small starter vendors, and this is how we at Zen Lending kind of help our clients get that business credit started for them. Start with small business starter vendors. These are trade lines which provide net 30 terms, which is not too bad. They're likely to be and you're less likely to be turned down, and they often do not pull your credit reports at all. But as we're going to get into later on in our Let's Talk Money Mondays, there are things you have to do prior to get or requesting any starter vendors credit lines. They are easy to do, but if you don't have these building blocks in place, then they won't be able to do it. So that's something you will want to consider. Now, continue to develop the good repayment history means after getting 5 to 8 trade lines, move on to revolving store credit. As before, you pay on time and in full. With 10 or more store credit accounts, move on to fleet cards. So fleet credit, and then this helps you to build credit to maintain fuel and repair vehicles. And once again, pay your bills on time, every time, 100%. After getting 14 or more lines of reporting, move on to cash credit. Your limits will tend to be higher and are acceptable in more accepted in more places. And these are vendors more likely to have what you need. This is what you're going to try and get for. This is what most of people, when I first start talking to them, this is what they want. Business credit cards and things like that. But the first thing you got to do is pay your bills on time every single time. Now, about the only thing that you could do about the length of credits history is to be patient and allow it to just allow it to go. That's it. In the meantime, you could build credit via trade lines and more. And then as the time passes, you'll start to build it up from there. And you have more pay experiences under your belt, actually reporting to your business credit. You could prevent some derogatory entries by being responsible with your credit. Businesses which pay on time and in full are less likely to go to collections, and they have a lot less likelihood of being sued, at least for non-payment of the bills. After a year, try contacting the credit reporting agencies and see if you can get a derogatory item removed. Now, they could say yes, they can say no, but if you never ask, you'll never know. And worst thing they're going to say is no. Be creative when you come up with collateral. An investor might want to help you out in exchange for a piece of your business. Your business accounts receivable can be tapped. This is a big one, especially if you do manufacturing, because it takes the time between the raw materials and the finished product to sell. And that's where you're going to be able to get it. If you get a huge contract for a piece of equipment or whatever it might be that you manufacture, you'll be able to tap into that contract with receivables and be able to fund that contract on its own merit. It's kind of quite a thing. It's an interesting way of getting the funds that you need. You can also use your equipment and inventory as well. Zen Lending and Consulting can help you with that if that's something you'd be interested in learning more about. You can't always predict or improve your cash flow, but you can fire clients which don't pay on time, or you can give your uncollected invoices over to a factoring company. We have a great one here in El Paso that I like to use, and they do a lot of good stuff for truckers. So that's kind of a great way of keeping the doors open, especially if you're an owner operator. You don't want to be spending time doing the books versus out there driving and collecting that money per mile that you make. Factoring companies for a piece of your invoice will pay you a majority of your invoice and then collect from your debtor the full face amount. And again, this helps to normalize your cash flow, because the one thing about factoring is it doesn't go into the bad debt or a loan or anything like that. It's in its own category. It's in a category all of its own, and they'll be able to help you with that. And it's pretty really cool to be able to do that. So To recap, business credit accounts for business's ability to pay back its debt, not the owners. It is not subject to the Fair Credit Reporting Act. Creditors consider your business credit score, and also your payment history. So pay your bills on time, every time, 100% of the time, and then you're ahead of the game. Okay. Creditors also consider the length of credit history. So, that will just take time. And so, what are you going to be able to do? How are you going to be able to have your company work through that time frame that it's going to take to actually build your business credit? Word of advice is, if you decide to go into business, it doesn't matter what the business is. It doesn't matter if it's a one-man show. It doesn't matter if you're an insurance agent, if you are a nonprofit organization, a for-profit organization. The one thing that I would highly suggest, is get your business credit started. Once you get the foundation taken care of, then you could take your time and build on it. But that foundation and that time has already started without having any type of now racing to the finish line and all that. Get it started, get it set up properly, and then grow from there. It makes life so much easier. So the length of credit, the creditors will consider the length of credit of your history, any derogatory items on your report, what kind of collateral you may have, and the cash flow from your business. There are 3 different ways to get funding: cash flow, collateral, and credit. Those are the 3 C's of business, getting business funding. Creditors check the balance sheets to determine the business credit worthiness. Now, they investigate current ratios, quick ratios, debt to equity ratios, receivable turnovers, and interest coverage ratios as well. Now, if you're like, Brian, this is a lot of information. You're right, it is. But I also wanted to get it out there. You can save this, watch it again, or you could do a very, very awesome thing. Give our office a call, and we will work with you and get you to the right people to see what we can work with, how we can get you the funding, and if we can get you the funding, what that funding is going to look like for you. So that makes it so much easier. So work to improve your credit worthiness, pay your bills on time, and build your business credit the right way. And it will always help the right way. So there are tons of different ways to do the same thing. But what we like to do is we like to give you the roadmap, and we like to give you step-by-step instructions. It's not step 1, 2, 3, 4. No, it's step 1, sub-step 1, sub-step 2, 3, 4. And that way, not only is it very they're built in chunks that are very digestible, but also it makes it so much easier when you have a question and you call your advisor and you say, hey, I have, let's say I just moved my office. I just want to make sure I hit all the important, I'll make sure my ducks are all in a row. They're going to turn around and say, hey, check out, step 1.3, step 1.4. So now you can go directly to that location to it. It makes it so much easier. So make sure you build your business credit the right way. It just makes it so much easier. Try and stay out of derogatory hot water. That's story of my life. Story of my life. When I first started, I had everything. I thought, man, this is going to be awesome. I got myself into some interesting situations, and this is why I can talk about business credit and building it properly and getting everything that you need done. Put all your ducks in a row. Once you're able to do that, then you're able to make sure that everything is is in the up and up, and you can build your business on a solid foundation. Be creative when you come up with collateral. There's a lot of collateral that can be done, and it doesn't even have to be your collateral. Think about that. It doesn't even have to be your collateral. So if you have somebody who is willing to put up collateral for you for your business, we can talk. We can make sure that that's taken care of, and that it's done in such a way that protects the your partner, the person that's putting up the collateral, the business owner, and the business itself. Get your company into a good cash flow rhythm. It's like the second biggest thing ever. Pay your bills on time, but before you can do that, make sure you have a good cash flow rhythm before. And don't overextend yourself. Don't try and build your company bigger than it needs to be at that current time. So that's the 5 critical factors that determine your credit worthiness. Now, again, if you have any questions, any concerns, you want to talk to somebody, you can give me a call, 915-229-4891. You can email me at info@yourzenlender.com. We definitely be able to help you out. Now, next week, we're going to be talking about bootstrapping your company. What does that mean, and how does that actually work? So that's it for me. I hope you have a great, awesome week. It is Monday. And so let's just get Monday out of the way and start on a good, fresh Tuesday. And hope everybody has a great week.